Now is the time, the most difficult time, because we understood the environment. We have to make forecasts. Please welcome Jean-Christophe Caffet, Chief Economist of Coface. I think it's cautious thing to take some water first, right? Is this a sign, the quantity of water? I'll add some water. Okay, nothing prepared here. We'll start with the word of transition, with what has been said during the first panel. What does it inspire you, the geopolitical environment, Jean-Christophe? It's the return of history. The end of history. You remember this book written some 30 years ago. The theory was to say it was the end of the victory of democracy, liberal democracy, over any other form of ideology or political regime. I think what we've heard this morning is crystal clear. We're far from the end of history. We have no guarantees, no insurance, and the future and international relation is uncertain. What do you think when you're a macroeconomist? From a professional point of view, we have to be very humble, very vigilant in the building and the monitoring of a macro script in the medium long term, given all the shocks that can come up. Macro is maybe a derived for the best and the worst, currently for the worst. The worst is not always certain. What is the outcome of 23? We had an inflation which strongly decreased and an activity that slowed down, but who resisted? Well, 23 was better than what we thought. Xavier said it. We should have had a growth of 2.5, 2.6%. The Forex is slightly more than we had foreseen last year. We were around 2%. It's linked, as Xavier said, to all the measures that were taken by the states, kind of interventionism, energy shield, subsidies, extension of some measures taken during the pandemic, in France with the extension of the loans guaranteed by the government and the robustness of the balance sheets, household resilience. When we look from a geographical point of view, the overperformance comes mainly from the United States, who overperformed twice what we had foreseen last year, but also some emerging states like Brazil, who amazingly survived, because growth should be at 3% for a forecast initially of 0.0. So United States inflation strongly decreased, more than foreseen. Yes, it was a good surprise on 23. Lots of reasons for that without getting into the details of the indexes, the ways of the various components, the rents and this. Many reasons for this disinflation, which is stronger than anticipated. First is the energy shock, same intensity as elsewhere in Europe, and the effects, the trickling down of this shock that were faster. Americans didn't have the same rise in the price of electricity and gas, and the shock disappeared more or less. The energy was really more expensive. The dollar remained strong all through the year. The terms were positive for the profitability of the American companies for the 2 and 3 past years. And gains in productivity we had in 23. That was a surprise for absolutely everybody, even the more attentive observers. The productivity gains surprised because they were high, and it slowed down the salary cost, the wage bill, and it more sustainable of the underlying inflation. And we didn't have that in Europe. No, we didn't have that in Europe. Europe didn't overperform. It did as foreseen. Once we put aside the extreme risks, a lack of energy, we had a weak growth with a strong heterogeneity. We had the southern countries, the bad guys who overperformed and knew how to capitalize on their assets, especially from touristic point of view. Northern Europe and Germany, more manufacturing, had a recession minus 0.3% on all of the over the year, and the year it doesn't finish better, according to the last statistics. Hence, what does it mean? 24 is starting badly. What is for you the core script for 24? Well, 24 starts rather bad in Europe. We have seen the figures published a few days ago, last week actually. Growth 0 at the fourth quarter, a little heterogeneity. Figures we have for the beginning of the year, first quarter, show that it shouldn't be better. Some slowdowns in some emerging countries. The United States has always good figures, but also slowing down. Basically, our script for 24 is the extension of the trends. Cross our fingers, good and bad ones. We have seen the same. It's not a good improvement or not a good or a bad way. Risk is rather in the impairment rather than improvement. Always possible. It's easy to imagine scripts which are much more negative, following a shock of offer, inflationist shock. What's in the Red Sea, Middle East is really concerning, or a shock of demand, deflationist if something should go wrong in the financial sector or consumer side. Our core script for 24 is rather on the Occam's razor, and with a slowdown of the growth, we will be at 2.2% globally, with a slowdown coming from the economies who overperformed last year. United States, who lost 1 point of growth. China, who didn't really overperform given the perspectives suggested by the reopening of the economy, but that will lose also 1 point of growth. And crossing our fingers, we can hope a rebound in Europe if Germany performs. So the core script is the most important point there, is that the price of commodities and mainly energy should remain wise but volatile. And this is the most important thing, the ongoing process of disinflation, globally speaking.
I'd like us to speak about China. You seem bearish with regard to the consensus and the objectives of the Chinese government. Isn't this a new risk too, especially if there's a stimulus package that comes around? Well, I'm not fully convinced by the people who say that China is over. If you leave geopolitics aside for a moment, China always has assets if it puts its money where its mouth is in order to grow. Education, infrastructure, technology, innovation, and so on and so forth. I think that China has the wherewithal to jump out of the medium income trap. This subsumes reforms, notably when it comes to welfare, so that consumption can at last become a growth driver. Consumption declined 2 points against GDP, from 39 to 37%, 2 times less than what has happened in developed economies. Anyway, in the short term, China is still grappling with significant headwinds: manufacturing capacity, property development, deflationary pressure, and so on. This will be dealt with by our chief economist for Asia later on this morning. But to come back to your question about stimulus, it won't change much if there's a major stimulus package unleashed. You have to change the engine, and bring in fuel doesn't change much. Regarding inflation, do you think that the battle is being won? Can the central banks claim that they're winning? Well, they haven't done much, to tell you the truth. Nor are they to be held responsible for the inflation itself. I may be provocative, but I think that central banks are given too much credit, so to speak, if you'll excuse the pun. Maybe they're given too much power, maybe they're deemed to have too much power when it comes to consumer prices. Their impact is very indirect when it comes to consumer prices, whereas there are more structural players. Demographics, globalization, trade integration, supply chain integration, technology, access to abundant, affordable energy. Those are the factors that determine consumer prices. Monetary policy does not affect consumer prices to the same extent. There is the stability of consumer loans, however, has allowed the monetary policy to be extraordinarily expansionistic, and it helped asset prices to skyrocket. But that's not what we're talking about. Inflation. For inflation, which doesn't have to do with monetary policy, has an impact on commodities, notably energy, and the stabilization of prices in a context where supply chains are coming back to normal and household consumption is balancing out with regard to services. Services, the prices of which are quite buoyant, anywhere between 4 and 5% yearly growth in the developed countries. So in terms of disinflation, we have to determine whether it's possible to go beyond these two types of inflation. And the turn of the screw orchestrated by central banks, it's been 2 years since Fed, will have an impact on demand. But will it bring inflation back, stability back? So you don't believe that interest rates will go down fast? In Europe and the US, maybe there will be an announcement in the spring. I do not believe in what some analysts believe. 150 basis points over the year, because central banks will want to be certain that inflation is back to 4%. Core inflation is 2 times that, although short-term forecast is rather optimistic. At any rate, whether they drop up to 150 basis points in the 12 months to come or not, it won't be the same interest rate situation as over the past 15 or 20 years. And in fact, the extent and the timing of easing of interest rates by central banks, well, that's not essential for the real economy, for Main Street economy. I think that some things are, bloated, overemphasized. I'm not saying it's not important, but it's for a fixed income trader, it's probably important. But for the CFO of an industrial firm that has debt, the debt was underwritten under better circumstances at near zero interest rates. So anyway, the rate universe, apart from what banks are going to do in the very short term, you think that interest rates will remain high for a long period? Yes, I think so, because from a geostrategic standpoint, the situation is the same as the macroeconomic situation. Things are changing. We have shifted from a situation where there has been surplus savings, the global savings glut that Bernanke spoke about at great length, to a lack of savings now. Why? because the need for investments have considerably increased. Energy transition, nothing new, of course, but today it's accelerating because this decarbonization objective is coming against the supply safety situation with the war on Ukraine. It's the equivalent of all the U.S. trade that will have to be put on the table, that of the last 10 years, in order to decarbonize, in order to meet the carbon neutrality objectives. And it's twice that if you consider infrastructure needs, transmission networks, and so on. Second, defense. It was quite clear in what was presented a few minutes ago. Rearmament increase in military capacity, technology, that's going to call for a lot of investment too. Population aging, medical care, pensions, latest OECD estimates show 3 points of GDP in additional funding that need to be found in most developed countries, up to 4 in France and 5 in Italy, 5 GDP points in Italy. And industrial inshoring, strategic autonomy objectives, colossal amounts that have to be invested to produce semiconductors, strategic equipment, and that is going to eat up global savings. Huge investment and financing needs moving forward. With less savings. Yes, less savings. Less savings available for developed countries, on the one hand, because saving surplus that was accrued by emerging countries and recycled in developed countries, this surplus has been shrinking with the rebalancing of the model, growth models of these countries, China, but it's also the case for Saudi Arabia, which with its Vision 2030, which will cost $3.2 trillion. You heard the Leon project, a huge ticket there, and a huge price tag there. And the countries that do generate savings surplus do not necessarily want to recycle that surplus as in the past, because they may quite rightly fear the solvency of the borrowing countries, or because they can also legitimately fear that the reserves are frozen in the case of a conflict with the U.S. This happened with Ukraine and the freeze of Russian reserve. Take China. The Chinese hold $550 billion lost over the past 10 years in terms of holding U.S. debt. So, in other terms, emerging countries, Gulf countries, China, have alternatives than financing the U.S. deficit or French welfare. A word about Japan. The rather easy monetary policy has changed, so they bought out plenty of U.S. and European public debt. And now things are changing, and there will be more. The money will be geared towards domestic debt because the yield is no longer at zero. So now we're entering a world where there will be an increase in investment needs, scarcer available savings. Interest rates will therefore rise apart from the monetary policy impacts. And quantitative tightening is just starting. And not to mention inflation, which will be structurally higher than it has been. Last year, you spoke about a risk of medium and long-term stagflation. Do you still have this long-term view? Inflation is being overcome in the short term, although it's a long and winding road. I do have the same vision, yes. The world has changed. Not only do I believe that the world is structurally becoming more inflationary
nécessaire acceptation, si vous voulez, de ce régime d'inflation plus
We
élevé.
have to accept this necessary inflation,
Réflexion autour du partage de la valeur.
sharing value, impact on the profitability of capital, and so on. So I fully agree with what I said last year. But in the 10 or 15 years to come, I think that we've entered a world where we are gradually
Le bénéfice
losing the benefit of a triple dividend. The first was the carbon dividend that we spoke about at great length yesterday.
c'est communément admis que
It's now widely accepted that the use of fossil fuel has helped humankind get richer, especially in certain countries. The energy transition will lead to inflation. Less fossil fuel, more green means more inflation. Demographics is the second factor. In developed countries, population has been aging, and at the same time, there's a drop in the working class. So there will be more consumers, less producers, and will have impacts on the labor market because the drop in labor supply raises salaries, especially because Western countries, not only those led by populist leaders, set up restrictions on migration flows. Also, as mentioned earlier, there's a gradual decline of the peace dividend. The recomposition of supply chains, diversification of supplies, all these China Coast One, French foreign strategies, all this is good for inflation. So inflation is not a subject of the past at all. So you're saying more inflation, more investments? Are we certain that everybody will subscribe to that view? Do you think Germany will subscribe to that approach? And do you consider that Germany is the ill patient in Europe? No, not everyone will subscribe to what I'm saying, but it's not about whether we all subscribe to that, but when things happen, you have no choice. Unless you want to maintain the economy you're in charge of in recession mode, underemployment mode, to maintain inflation at 2%. I don't think it's advisable in the long term. So in order to be optimistic, I think that everyone will end up accepting this new situation. We're not talking double-digit inflation. We're just talking more than 2%, right? That's all I'm saying. Now, Germany. I think it's fair to say that Germany is once again the ill patient in Europe. Bad news for Europe. Sigmar Gabriel should be here. It would be great. To combat economic policy choices were made by Germany since Schröder, early 21st century. Well, the choices made have been rewarding in the past 15 years, but they no longer are. You know, the German strategy based on energy supply that's affordable from Russia and seeking outlets in mainland China, that no longer works because the world has been fragmenting. Russia, to come back to what Thomas Gomard said, has been disconnected from the Occidental aspect of globalization, and the growth engine must be changed in the interest of growth. So this subsumes that a post-strategic agenda is necessary in Germany, especially because Germany is lagging behind in terms of investments in information technology. It's 2 times less that's invested than in France or in the US, not to mention infrastructure, where there's a problem too. That said, Germany has deep pockets. It's one of the few countries that can still meet the Maastricht criteria. If the public deficit below 3%, public debt 65, We're not talking about France here. Doesn't even compare. So anyway, Germany has deep pockets, but political will is the issue. First, they have to agree on the diagnosis, and two, on the remedies. Given the current political situation in Germany, it's difficult to reach consensus. Let's speak about political risk. This is a specialty at Coface, and you recently released numbers that are pretty scary. Do you think that there will be political turbulence or a social flare-up in the coming years? The latest delivery of the social fragility indicators this was in early November, demonstrated that the social fragility had significantly risen in 2023, record levels excluding the pandemic. We're looking at records in 116 countries where the risk level is above the pre-pandemic average. Overall, the common denominator is inflation, which has fanned the flames. And that does not bode well given the elections coming up all over the world. There are plenty of elections this year in the world. Taiwan, Pakistan, Indonesia, India, running up until November in the United States. I would like to close on something more concrete. Company bankruptcies. What is your take on that? Well, our vision for defaults is in line with our central scenario. Continuation of the trends, an increase still going on in 2024. In our central scenario, where disinflation continues, the margin squeeze will be even more blatant given salary costs, where interest expenses will rise as companies will have to pay back debt under circumstances that are far less beneficial than when the loans were taken out. And cash situations have been hurt in certain industries, as is shown by the rise in the number of defaults in recent months. And that is where the main risk lies. Earlier, we were speaking about endogenous risk, which could make defaults speed up. Things were pretty well in 2023, given a virtuous circle, not many jobs destroyed, and household savings supported consumption in spite of inflation. This could lead to a vicious circle should there be an acceleration in the number of defaults, which would destroy jobs, increase unemployment, it would hit salaries, and there would be an impact on consumption. And the situation would be pretty bad in spite of lower inflation. Thank you very much. Jean-Christophe Caffet, Group Chief Economist at Coface.